Hey, I'm Harry Rongard, editor of Money Morning. So in this weekly update, we're going to do something a little bit different from what we've usually been doing. So instead of one talking head, you've got two. So I've got Selva with me from
Hello.
Markets and Money. And today what we're going to talk about is interest rates in Australia, a little bit all over the world as well, and what could happen to the Aussie property market. I think that they have, but obviously I think it's only one half of the question, one half of the answer. So you have cheap money, so it's easier for borrowers to go borrow money and spend it on housing, but you also have a very willing banking system to lend to homeowners specifically. And if we're talking about what these loans are for, these are consumption loans. They're used to bid up the price of fixed goods, which is land prices. And I think that with banks so eager, because I think almost 80% of their business is home loans. So all this money, trillions of dollars, is going into all these land purchases, and there's obviously only a fixed amount, so it's bidding the prices up. So I think it's not just the price of money, which is interest rates, but also the quantity of money that's flooding into this home loans and mortgages and investor loans and all this kind of stuff just to bid up the prices of property prices, and I think that those two things in particular has inflated our property market, and they're obviously coming all the way back down once you've seen these tighter regulations around lending and what they can and can't do, and kicking investors out of the market, and prices are still quite high, so first-home buyers can't actually get in. What do you think though, Salva?
I agree with you actually. I think that we've seen cheaper money, lower interest rates, which has helped in maybe getting more into more debt. That's why you're seeing the high debt levels in Australia. No, I think it's something about 120%. Household debt is 120% of GDP, which is quite high. And also access, I think even a bigger one is access to easy credit, so that people can go to the bank and get a loan, and maybe they can get a loan for one property, 3 properties, just off maybe the first property.
And just have it all interest only. They're just paying interest only, and they might get a couple, and then but once the interest rate go up, then
which works when it's going up. But when housing starts to lower, it's harder to refinance. And I think that's a bit of what you're seeing now with people. Maybe I think there's a couple of things. There's maybe a change in sentiment, which people are starting to see that maybe you're not going to make as much money in the future with properties that we've seen in the last years.
Yeah, because we're coming off like a decade, almost a decade-long run of property.
I think is it 2009?
Yeah, something like that.
Sure, yeah. So I think the change in sentiment, I think, is going to change, and then also banks tightening lending. So
which they don't want to do, but they're being forced to do.
But they're forcing to do. Yeah. And then, do you think we might see? I mean, we might see we're seeing a lot of the central banks actually changing stance. We're seeing the Fed kind of stopping on their higher interest rates. You've mentioned before that we've seen the European Central Bank also kind of changing a bit of what they're looking at doing, and also the RBA, who has been talking about higher interest rates, and now it looks like it might go lower.
Yeah. If we do have lower interest rates, I don't generally think it will push property prices up that much. I'm sure it will help out a lot of borrowers. So as you mentioned, like a lot of them might have borrowed a bit too much, and they can't go from interest only to principal and interest payments. They have to sell or do something with it. I think, like I said before, the interest rate would only be half of the equation, and sometimes it's not even the important half. I think the more important is the quantity of money going into this market and the bank's willingness to actually do that. Because we just came off the Royal Commission. The banks have said, even though they're not going to do it, I think Westpac is going to do it. They're going to get rid of their wealth segments in their banks, and basically they're kind of walking on eggshells at the moment, and they don't want to be blamed, even though it's easy to point the finger at them. That they don't want to be blamed for inflating another property bubble that we've seen. So I'm sure lower interest rates might increase prices a little bit. It'll give, obviously, serviceability will help people out in terms of serviceability, but if the banks aren't willing, because I mean, it's not the central bank, it's actually the commercial banks that are printing this money. if they actually don't print the money for these borrowers or these first-time buyers, actually go and buy these houses, I don't think you would get a run-up that we saw from 2009 to 2017 again. But in saying that, that doesn't mean,
Yeah, it can happen.
Yeah, that doesn't mean it can't happen. I mean, I'm sure you might have a different opinion of that.
No, I think I think the same. I mean, I don't know. I saw a study actually from the RBA, where he says that they actually say that in a new paper, they conclude that the reduction in real interest rates account for most of subsequent boom in dwelling prices since 2011, and they say that per 1 percentage point in every real interest rate, it's boosting Aussie house prices by 17%. And that's based on cost of owning property between 1987 and 2018. So the RBA itself is concluding that lower interest rates will boost prices. So I'm thinking, yeah, it could boost prices quite a bit more, but
do you think that they will lower interest rates to help out?
I think the next move will be down, yes.
Yeah, because obviously a lot of the big ticket purchase item for these people would be houses, and a lot of their incomes are going on these houses. So if interest rates go up, then you'll have more people spending towards their mortgage rather than spending in the economy in general. So that could be a thing. They might lower rates because they want to help housing prices keep going and even help out the repayments of those loans.
Yeah, I don't think, as you said, I don't think they'll go up as much, because I think that costs are like households are struggling with higher costs. So I think if there's so much debt in the system, that I think if you lower house prices, at least maybe they'll stay the same. Maybe it stops the fall a bit, maybe it rises a bit, but I don't think you will see the increases that we've seen in the last few years.
Yeah, definitely. Well, but it kind of seems like it's not just property as well. It's also, stocks and bonds. Everything just seems really high at the moment. Even though property has come down a little bit, it just seems everything is really high. And I think in part that's because central banks are saying the right things. Investors get a little bit scared, like they did in December last year, and the central banks come in and go, no, don't worry. We'll make sure we'll maintain everything. We'll help the system out and make sure that we don't have any kind of recession or anything like that. But what they're doing, like you said, they're just pumping more debt into the system. They're just buying bonds with newly created money, and they're just encouraging these banks to actually lend out more loans. And these loans aren't going to productive things. They're not going towards businesses to, produce more goods and services, which you get economic growth from that. It's going towards housing
and the more debt that you get into the system, the less growth you get in the system at the end. So it's a double-edged sword. They want it to grow a bit more, but they have to put more debt in. Exactly.
And they don't want to put too much debt in, and that means they don't get the growth either. So I think it's a very tough situation to be in. Obviously they have a hard job, these central bankers, because I wouldn't even want to be Draghi, in the ECB. I wouldn't even want to try, because he's got interest rate for how many countries? Like 27 countries. He's got to manage the interest rate for. And he's the wizard who knows what interest rate would help not only Germany's economy but Spain, Italy, all these other countries within the Eurozone. I just can't imagine a job like that. Obviously Japan's a very different situation, and there's a lot of similarities between it. Like they have negative rates, don't they? And they have mountains of debt. They just continue to buy the government's debt, the central bank does. And they have it's more of like a national socialist type country where they all agree, they've all bought into this common good. We're all going to provide welfare for everyone, therefore everyone has to keep working. But obviously they have a demographic problem over there in Japan. But I can see why you would draw that similarity. Obviously everyone has come down in the interest rates, and debt just keeps ballooning out. And as we mentioned before, you have to lend more to get more growth into this economy, which leads to just more debt. But I don't think we will get as dire as Japan And if we did, Japan would be in a better situation than us, because I just think that Japan has the cojones to kind of let their central bank buy up debt. It's almost like I said before, it's where they can give power to their central bank, where they create a whole lot of money. They buy up all their debt, they leave it on the central bank balance sheet, they let it go bust, and they basically just funnel more money into the system and clean up banking balance sheets so they can actually lend. I don't think we'd go the way of Japan, just a summary, but I think we will be in a much worse position than Japan if we were to go that way. But what do you think, Selva?
Yeah, I agree in the sense that we're not going, I don't think it's as dire as Japan. I think because the basic thing for me is that the demographics are different.
Yeah.
You have a lot more aging in Japan, and I think in Australia you have a lot of immigration. So far you have young immigration, and that is the time when I think maybe that housing market, maybe not now, but maybe in a few, like maybe decades from now, maybe it goes up again, but we could see some stagnation, and I think that's where we're going near Japan, is the sense that we're not seeing inflation.
Yeah.
We're seeing low interest rates, and we could see some stagnation, and that's the trick actually, to get out of that and starting pushing for growth and sparking growth.
Well, that's why they're doing it, isn't it? They're just trying to increase inflation, but it's not even coming.
Yeah. Well, there is inflation, it's just not coming into the salaries.
Yeah, so it's just, I think that it's then you have to ask, why are these low rates? Like, why do we look at a country like Japan and say they've got incredibly low rates, they're negative, they buy all these bonds. Why do they not have inflation? Like, why do we want to follow a model like that? Because that's the model that we're all kind of going towards. We're all coming down, and even though the RBA hasn't done their huge quantitative easing, they haven't bought tons of bonds like the Fed or the ECB, it seems like, maybe you could correct me, but it seems that a lot of commentators feel that we're going that way, where if lower interest rates for us do not pick up inflation, do not pick up growth, then we might see the RBA enter the bond market and start buying up a whole lot of bonds. Do you think that could be a possibility? Or?
I mean, anything's a possibility. I think, yes, like Japan is a very different market in the sense that it is shrinking, and Australia is still growing in a way. Like, the population is still growing, and it is a younger population. So I think it might feel growth in that sense. But we are looking at stagnation also with the low inflation. I think there is inflation. I just don't think that is going into wage growth, which is where it has to go.
Yeah, exactly. Yeah.
If you like my discussion with Harje from Money Morning, please hit like and let us know in the comments what you would like to hear about. Thanks.